If you're trying to build a portfolio and you're chasing rate as your number one priority, just go directly to the bank.
I think the perception with rooming houses has come from share houses. So people do think that you're getting a lot of people in there that are, mooching off Centrelink.
Underinsurance is the biggest issue that we see. Building costs, labour costs, replacement rates gone through the roof.
You'll spin your wheels, you'll try and get the cheap money rather than getting the money that's actually going to get you, or getting the funding stack that's actually going to get you the deal. If you actually already have a property inside of a self-managed super fund and you have a loan on that property.
When you are doing the same deal type and you're dealing with the same client type over and over again, your ability to get the options and the strategies to the client in a refined, fast manner.
No longer is a property manager just a rent collector for you.
For heaven's sake, if it's with one of the major banks, please get in touch with me. I actually helped a client that was on 10.74% get their loans down to about the 7.1% mark. That's almost a 4% saving. Hey buddy, welcome to this episode of Finance This Property That. Want to share with you a question that I've been asked by a few people now. With the rates stabilising and some really sharp fixed rates coming on the market, I've been asked, look, is it time to fix my rates? Do I keep it a variable? Do I split? How do I just choose the right loan setup? It can be really confusing for people, especially if you're just looking at the rate. So what I want to cover off on is what are some of the key differences and some things that the banks don't tell you. How your loan structure actually impacts refinancing, offset accounts, future equity use, but also growing your portfolio. And just go through, maybe when is the right time, or when would I recommend, fixing, keeping it variable, or even having it split. Sweet, let's get into it. So what is the difference between a fixed, variable and split, and what do the banks not tell you? Well, a fixed rate will give you certainty and less flexibility. However, you will pay for that over time. There's a report that's just come out that you will actually pay 20% more over time than, not 20% more. You'll pay more over 20 years on a fixed rate than you would on a variable, which, you're paying for that certainty. Yes, it's low, but you are paying for it. Again, the current fixed rates on the market aren't at the 1%, 1.89% or 1.79% that we were seeing. Obviously, you're getting a really good deal if you're on those rates, but you're all coming off them soon. Cool, variable. Well, variable rate is what it is. It's variable, it's flexibility. There is rate movement risk. But it also has some pros where you can have, full redraw facilities, offset accounts, etc. on there as well, which actually saves you on interest. And we can do some cool strategies on investments using funds and offset as well to reduce down owner-occupied debt, reduce your commitment, recycle that debt out into a potentially tax-deductible environment when you use it for investment purposes. Then there's the split. Yep. It's the best of both worlds. You've got part of it's fixed, part of it variable. And it will work when it's done right and done at the right time during your journey. So we'll get into that later on. So how does having a fixed rate impact your loan structure overall? Well, it does, because if you're fixed into a bank for 3 years and you want to break that fixed rate, you will more than likely pay what's called an early repayment adjustment. These could be very hefty, and it depends on what rate you are fixed in at versus what rate you are reverting back to. So if the rate's lower, you're going to actually pay a bigger ERA, early repayment adjustment, which then makes no sense to do that. The other thing, it locks you into that bank for 2 to 3 years, or however many years you've fixed into. It also means, there's not a lot of fixed rates on the market that have offset features. They have redraw facilities, but you can't access that redraw facility till the fixed rate term is matured. Great. Okay. So how do I access equity? Well, you can access equity, but you can only use that bank. So if you're fixed, unless you want to break it, pay the early repayment adjustment, which may not be worth it because the rates won't justify doing that. So you will end up being fixed that one bank. You've got that one bank's policy. So you may not be able to go and do what you want to do, like purchase another property. Again, that's what we look at. So the impact on that is actually quite great, especially if you're building a portfolio or an investor. So when would I recommend fixing, keeping it variable or splitting? Well, let's start with variable. A lot of my clients will be variable because you need to be fluid. You want to be able to access equity because each bank will have different valuations. Each bank will have different lending policies. We want, some of these variable rates will also have multiple offsets. You can pay them down early and we can recycle debt. So if you're an investor, you want to be fluid. You want to be able to, go, you're not determined by rate, you're determined by policy and value. When is a fixed rate good? All right, well, a fixed rate will be good if you want a bit of certainty and cash flow. Back when the fixed rates were a little lower, some of the investor clients were using 2 to 3 year fixed rates, but they were like 3-4%, and your yield was sitting at about 4.5, 5%. So it made sense to do it then. But at the moment, probably doesn't make a lot of sense. Not saying it's not, it'll be determined by your situation. But also a fixed rate where you're not purchasing any more properties for the next 2 to 3 years. You want a bit of certainty. Hey, look, a fixed rate may be the right thing to do. Or the other alternative option is split it. If you are in a place where you're not going to be purchasing any more property, or you need a bit of certainty, but also have a bit of flexibility, you could have a short-term fixed rate. We keep the strategy. The exit strategy is pretty flexible because we're not stuck there for the next 5 years, maybe 2 to 3, depending on what you're looking to do. But we also have that portion which is variable, so you can take advantage of the offset facilities, pay down that debt and reduce your commitment, and then maybe we can recycle some of that debt out as well. So how do you choose? Well, it's a conversation. And also it will depend on what stage of the buying cycle you're in. Are you growing? Are you in acquisition phase? Or are you in holding? Or are you in wind down? So it pays to just have that conversation. The information, I guess, on this podcast is very general in nature and doesn't take into consideration your personal circumstances. But if you want to talk about this with me, I'm very easy to find. At Dion Finance Specialist on Instagram, Dion Fernandez on LinkedIn. This podcast has its own website, financespropertythat.com.au. But until then, I'll see you on the next episode.